Welcome back. Today, we are going to talk about time. Not the time on your watch, but the heartbeat that synchronizes the entire digital world. Every electronic device, from your smartphone to the massive servers running artificial intelligence, requires a heartbeat to function. For decades, this heartbeat was provided by a 100-year-old technology, the quartz crystal. But today, we are analyzing the company that is killing quartz and replacing it with silicon. We are talking about SiTime Corporation, ticker symbol SITS. We have conducted a deep dive into their financial filings, ranging from their explosive growth in 2020 to their latest quarterly reports in 2025. This is a story of a company that survived a brutal, cyclical downturn and is now positioning itself as a critical, yet often overlooked, player in the AI revolution. Let's start by understanding the technology. Why does SiTime matter? Traditional quartz timing devices are bulky, sensitive to temperature changes, and difficult to integrate into complex systems. SiTime uses MEMS, or micro-electromechanical systems. Essentially, they build microscopic machines out of silicon that vibrate at specific frequencies. These chips are smaller, tougher, and more precise than quartz. If we look back at the 10K filings from 2020 and 2021, we see the first phase of their story, the disruption. During the pandemic, demand for electronics skyrocketed. SiTime's revenue surged. They were the premium solution for 5G infrastructure and IoT devices. The market rewarded them with a massive valuation. Multiple at this stage, the narrative was simple. SiTime is the Apple of timing components. They weren't just selling a commodity. They were selling a high-margin, high-performance system. However, the semiconductor industry is notoriously cyclical. This brings us to the difficult years of 2023 and early 2024. The 2023 10K reveals a harsh reality. Revenue collapsed. Why? It wasn't because their technology failed. It was the bullwhip effect. Customers had panicked during the shortages of 2021 and double-ordered. When the economy cooled, SiTime's customers stopped buying. They had warehouses full of chips they hadn't used yet. In 2023, SiTime experienced what they called the Great Inventory Correction. The stock price took a beating, and many investors wrote them off. But this is where the story gets interesting. Let's fast forward to the 2025 filings, specifically the Q1, Q2, and Q3 10Qs. While the general market was obsessed with NVIDIA and GPU chips, SiTime was quietly executing a turnaround. The inventory correction finally ended. But more importantly, the mix of their revenue changed. In 2025, the buzzword isn't just recovery. It is AI data centers. You see, as AI servers become more powerful, moving data between chips at lightning speeds requires incredibly precise timing. If the timing is off by even a fraction of a nanosecond, the data is corrupted. Standard quartz crystals struggle to handle the heat and vibration of a modern AI server rack. SiTime's MEMS oscillators, specifically their new Epoch and Elite platforms, thrive in these harsh environments. Reviewing the 2025 financials, we see gross margins stabilizing and returning to that premium 55 to 60% range. This is the hallmark of SiTime. Unlike competitors who fight price wars, SiTime maintains pricing power because they solve difficult engineering problems. They are the only ones doing what they do at this scale. Another key growth driver mentioned in the recent reports is the automotive sector. Electric vehicles are basically computers on wheels. They need more timing chips than gas cars. SiTime has been aggressively qualifying their chips for automotive safety standards. The 2025 reports show that this long-term bet is starting to pay off as EV architecture becomes more centralized. However, we must address the risks. No deep dive is complete without looking at the risk factors section of the 10K. First, there is customer concentration. SiTime still relies heavily on a few large distributors and end customers, including Apple. If a major customer decides to design out SiTime or switch back to cheaper quartz, it would be a significant blow. Second, and perhaps more importantly, is their manufacturing model. SiTime is fabless, but they have a unique dependency on Bosch. Bosch manufactures their MEMS resonators in a dedicated foundry. While this partnership is strong, relying on a single source for the core component of your product is a structural risk that investors must always keep in mind. So, where does that leave us today? SiTime has weathered the storm. They have transitioned from a company riding the pandemic wave to a company powering the next generation of high-performance computing. The balance sheet in 2025 remains pristine, with zero debt and a healthy pile of cash, allowing them to invest in R&D, while competitors cut back. The thesis for SiTime is not about a quick flip. It is a bet on the densification of time. As 6G networks roll out, as cars become autonomous, and as AI models grow larger, the world needs more precise timekeeping. SiTime is the only pure-play bet on this trend. They are the pacemaker for the AI age. Thank you for joining this analysis. We read the filings, so you don't have to. Make sure to check your own risk tolerance before investing. See you in the next video.